What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Linder. Happy FOMC Day. We are going to be covering that drop. It should be coming out here in about 4 minutes. Watch the markets, talk about it, and all of that. I am live streaming on YouTube and Telegram. Guys, if you're watching on YouTube, get over to the Telegram. It's a great place to hang out. All right, Fed. Share the screen. This is the Fed Reserve FOMC calendar. You can find that by just Googling FOMC calendar, and this will have all of the stuff that you want, including all of the SEPs, the summary of economic projections that come out every other meeting. We should be getting one here as well, as you can see by the asterisk there on the date. But we are worried about whether they're going to cut. So are they going to cut by 25 basis points or 50 basis points? FedWatch over here on CME says that there is a 4% chance of a 50 basis point cut. I think it's a little bit higher than that, but it doesn't really matter. It's still the unlikely option. The likely option is for a 25 basis point cut. One thing I've been watching diligently. Oh, here's the price of Bitcoin. As you can see, we got monkey hammered down, but let's go take a look at this 3-month. I've been watching this 3-month yield very, very closely over the last couple weeks. And if we put in the Fed policy range, this is what it looks like with a 25 basis point cut. And it is currently under that range. The 3-month is currently under that range. We saw that also as well back here. The 3-month moved independently of the Fed, went way below the target here of this 50 basis point cut and continued lower. And the Fed kind of kept catching up to where the 3-month was because the Fed is not the dog wagging the tail of yields. It is yields wagging the tail of the Fed. So when we go back over here, this does it. I mean, it's a little bit confusing because it is under this range. So, you could say there is this possibility of a 50 basis point cut. That's why I put the chance a little bit higher than the 4% that the Fed funds futures are pricing in. I put it about 20%, but it really doesn't matter. It's most likely going to be around that 25 basis points. Dex Invictus is with us. Let's see who's over here on Telegram. Natalia, Turkey, AJ, Simon, Phil, Nick 6, AJ, number 2, E, Point, Puddington, Green, Larry Jr. Thanks, guys, for joining me. If you guys have questions, comments, put them in the chat. I will be taking a look. Let's see. I think Green has something for us. Before I went live on YouTube, I was commenting on Bitcoin price being stuck at 115, and we're going to get old and gray by the time that it clears this range. Yeah, give it a few more years. That's what Green says. All right, let's go to the FOMC calendar and get ready for the drop. Have about 1 minute left. We'll be hanging around. I'll answer any of you guys' questions, comments. We're going to hang around for the press conference as well and just do, live reaction to that. I've broken down so many of those. I can really tell. I think I can read between the lines of what Powell is saying, and at least has something interesting to say about their verbiage. Okay, 2:00, refresh. Still nothing. Refresh again. All right, we got it. Let's go in to this, and we jump down here. So they're going to lower the Fed funds by 0.25%. All right. There we go. We'll read through that in a second. Let's go back here to the markets and look at what's happening. Let's go to S&P 500. First, share this tab. We'll do candles, and we'll go down to the 15-minute candles. So the market is liking this. I mean, kind of shot up right here. This very last candle was since that just dropped 1 minute ago. All right, how about Bitcoin? Let's check out Bitcoin. 116.2, same thing, same sort of thing. So it's positive. A lot of times, though, these initial reactions actually reverse by the end of the day. Don't think that's going to be the case today, but it's possible. All right, let's go back to FOMC statement and read through this a little bit. Recent indicators suggest that growth of economic activity moderated in the first half of the year. Yes. I mean, most indicators other than asset prices are indicating a major slowdown, including jobs. Job gains have slowed. They were reversed. I mean, we just had the update to the benchmark for non-farm payrolls. It was nearly 1 million jobs. If you put together the last 2 years of corrections, it's 1.7 million jobs that just disappeared, that were never created in the first place. Fake numbers. So job gains have slowed? Yeah, they've actually reversed, big fella. And the unemployment rate has edged up but remains low. If you guys are familiar with the SOM rule, I'm going to have to just Google it real quick because I want to get the exact definition. Okay, so this is indicator signals the start of a recession when the 3-month moving average of the national unemployment rate rises by 0.5%. So we have definitely seen that, and unemployment rate is ticking up but remains low. But yeah, that's what happens at a reversal. You know, the reversal has to start somewhere, right? And the reversal starts when unemployment rate starts edging up. So he's admitting to this reversal right here. Inflation has moved up and remains somewhat elevated. CPI prices, yeah, you could say that. I've been very surprised with how much the CPI has been able to hold on. But man alive, the shelter component is 2/3 of the quote unquote inflation that we've been seeing. If the shelter component is coming down very, very slowly, it does not have a mind of its own, like I've said for a long time. It will follow. But if you take out shelter, I mean, we're under 2%, and that's their goal. So that shelter component is really what is causing the CPI to stay elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Their dual mandate. Uncertainty about the economic outlook remains elevated. I don't like that they're admitting this. I mean, they have to admit that because they don't know, and we know that they don't know. But by saying that, it kind of corrupts your credibility a little bit, I would say. You don't want to tell people, hey, we have no idea what's going on here. Okay, the committee is attentive to the risks on both sides of its dual mandate and judges the downside risks to employment have risen. All right, so to explain that, for a long time during COVID and during the response to COVID, they were saying that the inflation side of their dual mandate, that was where the risk was. And so that's why they were raising rates so quickly, because the balance was way more favoring to fight inflation than to fight employment. Because see, they see it as a teeter-totter. If you push on the inflation, that means you have to raise rates, right? Push down on inflation to raise rates. But raising rates, they think, is bad for the economy, and so that will harm employment. So as inflation goes down, unemployment goes up. And so to get unemployment back on track, they think they lower rates. That will be stimulus, even though it's not. They'll lower rates, unemployment will come down, but inflation will go up. See, so it's like a teeter-totter, and they say right now the downside risks to employment have risen. Basically, it's taking control. That's why they're cutting now. In support of its goals and in the light of the shift in the balance of risks, the committee decided to lower the target range for the Fed funds by 0.25%. All right. In considering additional adjustments to the target range for the Fed funds rates, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Okay, but they also did an SEP like we talked about. So let's take a look at that. And we can zoom in. Let's go to this table. All right, so Fed funds rate, they think they're going to be at 3.6. Their June projection was 3.9, which would pretty much be right where we are. 4 to 4.25 is right above that 3.9. So maybe one more cut. But now they've lowered that to 3.6. So that takes us two more cuts, right? Yeah, that takes us two more 25 basis point cuts until the end of the year, and then nice and slow out to long run. They think they can hold it at 3% in the longer run. All right, what do they think about growth? So June projection, they had 1.4%. But the change in real GDP, they think now they've risen their expectations to 1.6%. That's interesting. So their GDP projections increased, even though, can I zoom in a little bit more even? Okay, hopefully you guys can see that better. So their GDP projections increased, but the economic picture deteriorated, so they cut rates. He's going to have to explain that in the press conference for sure. Unemployment rate, June, they expected 4.5. They expect that same, not any real difference into the longer run. PCE inflation, June was they expected 3% by the end of the year to hit 3%, and they still expect 3%, and they expect 2% in the longer run. How boring is that? Core PCE inflation, 3.1% and 3.1% and 2% out to 2028. So no real changes in these. The only real change was in the GDP calculation or the GDP projection and the Fed funds projection. So that's a pretty big drop from 3.9 to 3.6. So in other words, the market, that's going to be dovish, okay? Some people were talking about a hawkish cut. And what a hawkish cut would be is they would cut the 25 basis points, but these projections might actually increase to say 4% from 3.9 to 4. That would mean that they're not projecting any more cuts for the year, but they're cutting this time. That would be a hawkish cut. But this actually is a dovish cut. It's a bigger dovish move than just cutting 25 basis points because their projections are down here at 3.6. All right, so let's go back to the charts. Bitcoin's still trying to figure it out. One thing I wanted to show was I'll take this off. Distracting. Yeah, that's what I wanted to show was this, except go into the 3-month. Okay. So yeah, see, this is bouncing this candle. Now it's bouncing right back into this new range that will show up tomorrow on the indicator. But what I wanted to do was map on here Bitcoin and go through this real quick. Change your color. And let's hide this for now. Okay. So what I wanted to show was what happened. I saw some Ethereum accounts like trying to FUD out there about Bitcoin during the last rate cut. Sorry, just cleaning this up. Oh, and Telegram, I'm going to share a different screen because, yeah, sorry, I should have done that earlier. Okay, so as you can see, this is the rate cutting cycle last September. I mean, they started cutting one day later in the year than this year. They were September 18th last year, and this is September 17th this year. But you can see what happened to the Bitcoin price. That really put in that bottom and rocketed higher, like by 100%. Don't know if we're going to get the same move this year, but we do have this bottom put in of roughly the same time in relation to the first cut or to the September cut. So we will see what happens with the Bitcoin price. But the FUD I was seeing from some Ethereum accounts was at this last cut right here in December, Bitcoin fell after that. So they're showing that this cut caused the price to fall. And oh my gosh, do you guys know what happened last time the Fed cut rates? Price fell by 20%. Well, that's because you're looking at just that one part. If you look at the entire rate cut cycle, which the Fed is now signaling they're going to cut 2 more times by the end of the year, then we should expect something like what happened at the beginning of the rate cutting cycle for last year. I mean, it's an exact replay of what happened last year. Again, it's a 25 basis point cut. So instead of 100%, rise in price, maybe we get a 50% rise in price just because it was 25 basis points versus 50 basis points. But we'll have to see. We'll have to see, obviously, how this advances. Okay, so let's remove that, bring that back, and now go back out to the other markets. Let's take a look at the dollar. Now, I am expecting the dollar to bounce. I've talked about this a lot over the last couple weeks, relating it to what happened in Jackson Hole last year, and then the first Fed cut in September of 24, Jackson Hole this year, and then the first Fed cut in September of 25. And I still do expect something like this to happen. This could be a fake out, though, on the dollar. We'll have to wait and see. A lot of people think cutting yields, cutting rates is bearish for the dollar, but it is not. If you just look back at last year, they were cutting 100 basis points and the dollar rose against other currencies. And then if you take a look at things like the euro strengthened despite many more cuts from the ECB than the Fed. So the Fed stopped cutting here in December, and the ECB continued to cut. Okay, and the euro actually rallied in this part after the Fed stopped, and the ECB continued to cut. Why is that? Because if you believe it's stimulus, then you need more money. Right? The economy is going to demand more currency if you believe it's stimulus. And so that will increase the demand for that currency and the value will go up. All right. How about gold? Gold is making this nice run, continuing this run, another new high today. I don't really have, it's got to be overbought. Let's bring up the RSI. Very overbought for gold. You're sitting at 80 on the RSI, which is extreme overbought conditions. So I wouldn't be surprised with a retest of the breakout down to the yellow line. Do I think the run for gold is over? Maybe for now. I thought this consolidation was going to extend the entire year. It did break out here. So kind of coming down and back testing this breakout could be, a continuation of this consolidation for the entire year. And then Bitcoin always follows the moves in gold. So gold will rally, it will kind of consolidate, and then Bitcoin will really take off. And we are kind of setting up for that. But these two assets are climbing for the same reason, gold and Bitcoin for the same reason, because of counterparty risk. It's not due to inflation. Okay. Maybe some of it is 2 or 3%. But the reason why these assets are rising in particular is because they do not have counterparty risk. And at the end of a 75-year credit bubble, you're trying to find safe places to put your capital that doesn't have this exposure to credit defaults or credit implosions that we're going to see here in a recessionary move. So for the same reason, gold is going up, Bitcoin is going up as well. All right. Let me see if there's any comments here. Phil says, how much of that BTC move do you attribute to the cut cycle versus Trump election. Okay, let's go back to that. Hold on a second. And we'll just go to the weekly and we'll talk about this a little bit. Logarithmic. Okay, so last September, this is what we're talking about. From right here, this move up, how much of that was Trump and how much of that was, did you say, the rate cut cycle? That's a good question. If we look at the 10-year, I've talked about this in relation to the 10-year. So it's very weird to look at this 10-year and see that rates were being cut, but the 10-year actually increased. The yield increased. Why is that? Well, one, the Fed isn't in control. We know that. But because the 10-year is about growth and inflation expectations. Growth and inflation are basically the same thing in a credit situation like we're in right now. All right. So you have, as they cut yields, if that is supposed to be stimulatory or stimulus, then growth and inflation expectations should increase and the 10-year yield should rise. There's also growth and inflation expectations from a Trump presidency because he's seen as being business oriented. He's going to cut taxes and that type of thing, right? So he would be seen as positive for the markets. So how much of this is due to the rate cutting versus Trump? I don't know. I couldn't give you a percentage. I would say it's basically, they're both working. So now if we apply that back to Bitcoin, I see what you're saying. Because we don't have the Trump trade now, right? The Trump trade is gone. So if this is 100% and all we have now is the rate cuts, but we still have the Bitcoin strategic reserve stuff like Michael Saylor today in Washington, D.C. yesterday in the big meeting that had Tom Lee, the shitcoiner, and other shitcoiners there, as well as Michael Saylor, talking about Bitcoin strategic reserve. We're still getting some of that, which will influence the price, and maybe they'll start dripping some of that. We were supposed to get stuff about that in September, I thought, right? I think Lutnick said earlier in the year, guys, wait for September. We're moving this forward in September. So we should start seeing some more drops about that. And that can also be bullish for price, which would simulate perhaps the Trump trade a little bit. But yeah, point well taken there, Tony. Or that was Phil. Tony, whoever said yesterday that Bitcoin would dump initially on the news of a Fed cut was correct. Whoever said it would dump on a Fed cut? What are you talking about? It's dumping? It's not dumping. I mean, I can see they were saying that it was priced in. It was not priced into Bitcoin. I know that because if you take a look at the daily, like we've been saying, we've been freaking sideways for 9 months. So there was no rate cut priced in to Bitcoin. Okay, let's look at the daily. So you're saying November 5th of last year. Let's go. Oh, don't move my line. November 5th. Is this November 5th? Yep. I see what you're talking about now. Trump winning the election. I don't know. I think that was kind of, it It was a moment where uncertainty was relieved. I don't think it was necessarily the information in the signal. It was the signal itself that the uncertainty was over and Trump wins. So a lot of that pent up price action from the uncertainty was released and it went higher. So I don't think that was necessarily the message itself. It was just the fact that the message was sent. I hope that makes sense. And I wonder what you think about that, Phil. Okay, let's go to see if there's any comments from YouTube. And gains reversed, Dex says. Well, let's take a look. Let's go down to the 5 minute. See what we're dealing with. Yeah, I mean, like I said, it reverses by the end of the day. I did not think that was going to happen today. I thought there was going to be some push up higher. This isn't a strong dip or anything. Where was this the exact minute? No, this one. So right here, I mean, 15.7, 115.7 was where the announcement was released. And it's just at 115.4. It's not like it's dumping or anything. It really hasn't picked a direction yet. So we'll see. We'll see how this works out. But yeah, this has been a very, very painful bull market. This has been a very painful bull market, especially, right from back here, right after the election, like we were talking about just a second ago. I mean, gosh, what day was this? December 17th. So 9 months ago, we hit, what was this price? 108 9 months ago to the day. And we're only at 115. Incredibly painful. Incredibly painful. I mean, it's not as painful as like 80% drawdown, but you guys know what I mean. I mean, this right here, breakout from the previous highs, right? I'm going to make this bigger arrow. So we break out from the previous highs right here. Oh, fake out. Bam. Crush you. Crush all your hopes and dreams. All you degen longs that got in on the break of the all-time high, which I probably would have done if I was trading, because that is the old school way of Bitcoin. And it's the way of the stock market too, for the most part. But this market is very, very controlled right now. And then new all-time high, crush all your hopes and dreams coming down here. So we'll see where this goes. It would be very painful to move up, make a new all-time high by 1%, like every month. That would be extremely painful. Oh man. I mean, how much was this all-time high bigger than? So from here up to here, 10%. Okay, so it went up 10%. But every 3 months you go up 10%. Oh my gosh, that would be so painful. If we zoom out, let's go to the weekly and then zoom out. I mean, this market is it's something to behold, guys. The crisp, straight nature of this market. I do see how this last wave has been disappointing. See how far these stairs extended away from the line. They extended quite a bit, and this one did not extend away from the line. So that's where some of that pain is coming from as well. But remember that the market has chewed through so many Bitcoins that have come on the market, like those 10-year-old Bitcoins. 80,000 of them were dumped in a weekend. Wasn't that right? Was it 80? No. I think it was 50. No, 50 was the German coins that were dumped. 80, yeah, it was 80. And then another 20 looked like they were being unlocked, something like that. You guys can correct me if I'm wrong on this, but the market really did a good job absorbing that. That might be why, we have a little bit less breakaway here. But if we do break away again, I mean, I could see us getting up to 200,000 by the end of the year on a breakaway after these rate cuts. So we'll have to see how this develops. Okay, let's see what other markets we have. MicroStrategy. Been seeing some people talking about this bottom signal. One thing I had on it was Let's see. Yeah, this one. It's hugging this 252-day moving average. And what's special about the 252-day? That's about how many trading days in a year. I think it can be 253 or 252. And so that's right on the 1 year moving average for MicroStrategy. All right, let's take a look. We did gold, dollar, 4 minutes until the FOMC press conference. How about oil? Oil's been very boring, guys. It's kind of, has this downward bias on the price. I don't really have a strong feeling in the immediate future what's going to happen with oil. But again, I still expect it to hit 50 before it hits 90. And S&P 500, new all-time high after new all-time high. Even on the day right now. Let's go down to the 5 minutes, see what's going on there. Look at that Darth Maul, guys. Wow. Wow. Spike, liquidate, come back to the middle. That is incredible. Holy cow. That's kind of exactly what we're seeing on Bitcoin as well. Okay, so that's it. Let me pull up the FOMC press conference. There it is. I'm going to share a tab here. Mute that. All right, let's go back into Telegram, see if you guys said anything else. Yep, DT. Oh, yep, Tony. Okay. I don't know if you guys saw that. I will have to go in and look for the tweet, but there was a image that was going around. I put it in the Telegram, and it was all the governors and voting members like sitting around a gigantic table, probably looking at some slides and watching different Fed presidents make their pitches or their updates on the economy in their regions. But it looks like a bunker, man. It looks like a sterilized hospital or something. It doesn't look like what I expected a FOMC meeting to be. Expected it to be like in a library, I said, something like that. But it looks very cold and sterile. And Lisa Cook is right in the middle at the corner of the table, not looking happy at all. So about her, guys, I do think that they're going to be able to kick her out. It's going to the Supreme Court. The Court of Appeals said, Trump's for cause is not good enough cause, but that's not their prerogative. And the Supreme Court has ruled on pretty much this exact same thing before from another quote unquote independent agency. And for cause just means any cause that the president feels is good enough, they're gone. That's why you elect a president. You can't have independent agencies totally totally insulated from any sort of electoral process. You can't have that. So these high up officials, they are able to be fired by the president for cause. And I think that will happen at the Supreme Court. All right, here we go. Pump my bags, J-Pow. Yeah. Well, so what to expect here? Like I said, this was a dovish cut versus a hawkish cut. They moved their expectations for the end of the year down by 0.3 of a point, over one whole cut. So they're expecting another whole cut this year. That's pretty dovish. And perhaps he's going to be talking in a dovish manner as well. I mean, the panic over the jobs numbers is real. I really do believe that. Yields are going crazy. France is having trouble. For the first time ever, their spread to the German Bund went over Italy's spread to the German Bund. So, I mean, France is in big trouble. China's in big trouble. Their rates cannot stay up at all. They have, over the last couple of weeks, maybe leveled out, but they haven't increased. So rates are just falling in a deflationary signal from China. At the same time, Japan's long-term rates continue to go higher in somewhat uncontrollable fashion. I mean, I thought they had yield curve control. No. There's no such thing as yield curve control. It's a concept that doesn't have any physical, mechanical reality. But yeah, so I think hopefully he has a very dovish Q&A here. Maybe some dovish slip up, like, oh yeah, we wanted to do 50 or, whatever. Okay.
Good afternoon. Colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a percentage point.
He said that somewhat elevated. Is that what they said in here? Hold on a second. Going back to the statement real quick. Yeah. And okay, yeah, so he's just reading exactly off this. Okay.
We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing.
Oh, I didn't go over that. So if we share this tab and we go down here, oh, no, where is it? The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. So that's QT, right? They're letting these securities roll off of their balance sheet, I think by $40 billion a month. And they're going to continue with that pace. So that's very interesting. Where are the people that say QE is money printing, and now they've been doing QT for so long? Their balance sheet has to be getting pretty low. Let's look that up. Okay. So we got the Fred website. The balance sheet is down to 6.6 trillion, down from a high of 9 trillion. So a third. You know how people for a while there, they were saying, oh, half of all dollars ever in existence were created in the last 2 years or something like that. Well, you could look at this chart and be like, if reserves are money, which they aren't, but let's just say they are for the inflationistas out there, that you would have to say that the money supply here in the form of reserves has dropped by a third. Not quite a third, about 25%, they'll say. 25%. Anyway, that's just nuance.
Economic developments. Recent indicators suggest growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing remained weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year, 1.8% next year, a touch stronger than projected in June.
We covered this on that table. I mean, guys, look at this flatness to this. What would you say you do here, Fed governors? I mean, what kind of model has this spit out of it? It is absolutely ridiculously, oh, so stupid. What kind of economic model are they using that just spits out a straight line like that? Oh, man. And when you see that, like, let's say you're a Fed governor, you're supposed to be very intelligent. I mean, Lisa Cook, you know, probably not the only exception, but they're supposed to be smart. And your projection, your model spits out this flat line like this. What do you tell your assistants? You say, this is ridiculous. Go back and figure out what went wrong. I mean, look at this actual, okay? Oh, but projection. Oh my. Guys, I can't take it. I can't take this.
In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and low labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition,
all right, let's listen to that one more time.
Past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation.
Lower immigration and lower labor force participation. Are they going to get political on the immigration issue? I mean, they're already getting political on the, sorry, my mic's squeaky. They already are getting political on the tariff issue. I mean, tariffs are a tax. Of course, the Trump administration says tariffs aren't a tax. It's paid by the exporter. Okay, that's fine. But really, a tariff is a tax. So a tax isn't something that should be within the Federal Reserve's purview, right? If prices are increasing because of a tax, which probably is a policy goal in the first place. I mean, you have to just assume that the policy goal, if you're non-political, okay, if you're not a political actor here, Powell, you have to assume that the policy goal is to increase prices. I mean, we put taxes on cigarettes, and those are, supposed to lower the amount of smoking. It's very easy. Increase the price, demand will go down. So a tariff, let's say it's a tax, and being apolitical about it, you would say a tariff, the policy goal must be to increase the price. So is that under the purview of the Fed to fight that political goal? No, absolutely not. The tariff should not, and see, that is the complication by one of the complications of measuring prices as inflation. Prices are not inflation, people. Prices go up and down for a myriad of reasons. Tariffs being one of them. Taxes. You have supply chain disruptions. You have weather, extreme weather events. I mean, you have all sorts of things that can affect the prices of things. And it's not inflation. So what is the thing that is inflation then? It's the supply of money. So why the hell don't they count the money? If M2 is a supply of money, why don't they count M2 and use that? Because they know it doesn't work. They know it's not what the money is. The money is an esoteric collection of things out there in the economy, cash and cash equivalents, in the shadow banking system. There's way more money, effective money, in the shadow banking system than in M2 that we can see. They can't count the money. It can be considered money one day, like it's a cash equivalent one day, but then it's transformed through all this financialization and repo agreements and yada, yada, yada. And it could be transformed into being less of a cash equivalent tomorrow. Or from that less of cash equivalent through the financialization process into being more like money. So not only can they not find it, but they couldn't even classify it for a length of a period of time. Maybe a single day they could say, okay, if these financial products look like this on this day, that's the supply of money. Maybe if they could find it, but that wouldn't say what it's going to be like tomorrow. There's a lot of overnight funding. 5 trillion or more goes on in the repo market every day. So no, it's very, very hard to do this. And that's part of the whole complication when you are trying to say what inflation is based off prices. All right.
Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen.
Yeah, damn right they have. One interesting thing is what's going on with these H-1Bs. So these H-1Bs, I don't know how much I should go into it, but there's a lot of nepotism amongst H-1Bs, and so someone from H-1B or some immigrant gets high up in, let's say, HR or into these into a position in a company where they're hiring. They will specifically not hire Native Americans, like the native population here. They will hire H-1Bs. And they would have to post these jobs publicly. Legally, they have to post them publicly, but they were posting them on very obscure forums or something like that. And so now there's these apps that are going around and scraping all of these obscure forums and finding all these job openings. And there's tons of people applying to these jobs now, from the native population. And the H-1B people don't like it. So the H-1Bs, I think, have drastically slowed down. Yeah, so there you have that. And what else did he say here? Let me go back a couple seconds.
In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual.
Yeah, so the supply and demand picture for jobs is really off kilter right now. There's also a lot of these ghost jobs out there where they will post these openings and they'll have these openings up for years and they'll never fill them. Right. There's different strategies that these companies use to show that they're hiring, that they're growing. Oh, that's good for the stock price. Look how many people they're hiring. They're trying to hire 5,000 more people, but really those are just ghost jobs. They might be only looking for 100. There's all sorts of different little tricks that people are playing. And so, yeah, the picture has definitely been clouded. That's why you have to trust your own two eyes. Go out there on Main Street, go to businesses, see what the traffic is like. Check out, middle of the week after work, check out the weekends, see what the different traffic is like. You'll be surprised. Talk with your neighbors. Talk about the economy. I might stay away from politics maybe, but talk about the economy and see what they are saying about it. People are not having a good time right now. The job market is not that great. So when he says supply of and demand for jobs is murky right now. I agree, but I think it's really falling on the negative side. And that is dangerous because, like the Psalm rule I read earlier, once it gets going, it moves very, very quickly. Like it's an exponential move up, and it has been going up. So,
In this less
not good.
dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter.
Oh, man. I'm going to look at the unemployment rate. On Fred. Okay, share tab. Okay, see how this unemployment rate moves? It's always trending in a direction. So here it's trending down, right? Then it's trending up. Then it's trending down. Then it's going up and down. You don't see any periods where it's flat. I mean, maybe back here you could say, if we go back to the 60s, you find a period of a couple years where it was flat. Maybe you could say back here in the 50s as well. And here. But recently in modern financialized history, you don't see that. It's either trending in one direction or the other. Now, if we look at the Fed's SEP, oh, magically, it's flat. And not just a couple years like the 50s and the 60s that we saw, but for the longer run, like in the foreseeable future. It's flat, guys, at 4%. We have cured economic swings. We have cured them. The unemployment rate is flat for as far as I can see. Oh, it's just so stupid. Okay, this one here, going back to this unemployment rate. Now you guys can kind of see what I have been saying. So the great financial crisis, I think, 2019, we're starting to roll back over into recession. The unemployment rate hadn't turned around there yet, but then we had COVID. All right. And this was just a relatively quick disruption, but it has since worked its way back to normal. And now it's ticking up again. So this is kind of a continuation of what we would have seen in 2020 without COVID. Without COVID, right? So the recession that we were going to get, that the COVID response kind of mitigated and pushed off, kicked the can down the road. Now this recession that was going to happen back here is going to happen now. All right, that's just a thought. Let's share this tab.
Inflation has eased significantly from its highs in mid-2020, but remains somewhat elevated relative to a 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year, and inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027.
Oh my goodness. I mean, I guess I can kind of see this because my projection is low growth, low inflation, but we will have bumps. This was a spectacular bump, but we will have bumps. Let's go and check out CPI all. Oh no, let's go to the chart actually, because I have this on the chart. Switch to that. I don't know what this arrow was for. But yeah, so inflation, even on a monthly here, it was pretty volatile within this range. It was cumulatively not that volatile. So this is different than the other things. You can see that it really stuck around that 2%. This was an aberration. This was an aberration. But since the great financial crisis, it has been generally pretty flat. And so I'm not going to ding them super hard on this because inflation does tend to be flatter like this. But if we're going into recession, which they don't see, by the way, if we're going into recession, then you'd expect this to be more volatile. Okay, let's continue.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year.
Is this a typo? They have 2024 here. We were in 2025. This must be a typo. Were the other ones like that? Let's see. 2024. What am I not seeing here? Guys, tell me why it says 2024 for the current year. Am I a time traveler? Okay, let's go to the dots.
Assessments of an appropriate path for the federal funds rate based on what...
I mean, even if this was fiscal year, which would end at the end of this month, which I don't think it is because GDP and stuff goes off of calendar year. Guys, I'm lost. What do you think? Are these labels wrong? Anyway, okay.
Each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the...
Okay, this is bugging me. Let's go to Let's go to the actual SCP here. Yeah, see, 2025. Woo. Yeah, see, 2025 through 2028. Huh? The heck? I mean, it's not that big of a deal, except it's attention to detail, right? I mean, I was in the military, and that's one of the biggest things, attention to detail. If you can't get the year right, it's just like this thing with Lisa Cook. If you can't get your mortgage application correct, there's no attention to detail. How can we trust you to be a part of making economic projections for the dang economy? I mean, obviously, there's a ton of groupthink going on right here. There's no dots outside of this, of the bunch. Nobody thinks that there's going to be monetary policy is going to have to go down faster. Nobody thinks that there's could be possible inflation that's going to make them think they have to raise rates. Nobody in the group on the FOMC is outside of their little groupthink bubble. There's no independent thinking whatsoever. I mean, Moran just got not confirmed, so I would assume to start seeing one bubble kind of going one way or the other here. But oh man. So just by having the date label wrong, then you mix that with their inability to do things outside and commit fraud, mortgage fraud, and then they're all groupthink. It can't just be me that thinks the Fed has lost incredible amounts of credibility. And when they miss this recession, when this recession does come and they're late, I mean, it does fit this general trend that we're seeing. Losing independence from the Fed, losing independence from some of these other quote unquote independent agencies as well. This is the era of populism. It's the fourth turning. Things are getting revamped. Okay. The Fed, if they go down this road, it matches and things continue as they are with little mistakes here, criminal mistakes elsewhere, groupthink, being late, inability to think for yourself. If they continue down that road, they're going to lose independence. I mean, this is the perfect setup. In 4 years or something, let's say, J.D. Vance gets elected 4 years down the road. And you look back and the Fed has lost independence. They are actually a subsidiary of the Treasury at that point. Okay, let's say. They've lost their independence. And then you look back on the last 4 years, and it's going to be clear as day that this was building this way. It was building. It didn't happen out of the blue. I'm pointing this out right now. I tend to be early to a lot of these things. And in 4 years, you're going to look back at this time and be like, that was so obvious. The Fed had lost credibility. It was late to the recession. It had criminals serving as voting members. The confidence is gone. Lost its independence. I'm not saying that's a good thing or bad thing. I'm saying that's what's happening. That's what's happening right now. And we won't know the full story until that down the road when it becomes blatantly obvious. Okay. But all that from a different date. Okay.
The end of 2026 and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course.
So he just went over this. If we go share this tab, he just went over this. So the drop from 3.9% is what they thought monetary policy was going to be at the end of the year, to 3.6%, which is a pretty big drop. That's why it should be a more dovish than just 25 basis points.
The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that actions affect communities, families, and businesses across the country. Everything we do is in service.
Questions?
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Myron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent?
I hope someone asks him, are you committing malfeasance when you disobey a lawful order from the president?
With this dynamic. Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Well, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market?
Interesting question.
Rather than in inflation?
But a completely separate question. It wasn't like a follow-up to the first one.
Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are...
Huh? No. Shelter is 2/3 of the inflation.
not very
Quote unquote inflation.
large effects at this point. And we do expect them to continue to build over the course of the rest of the year and into next year. And, you know, it's also possible and that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
That's not good. That's not good. I would ask him about the big revisions as well to the payrolls.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic
All
conditions
right, this is early for him. Usually he goes like about fifth or sixth, but second is pretty early. Maybe they want to get a rehearsed or scripted answer in here from Nick.
and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. But what we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong generation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to, to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Interesting. I mean, she's begging the question, if I'm using that term properly. I would say that obviously there's a risk to the labor market. Obviously, we looked at this unemployment rate, okay? The unemployment rate is going up. We have changed direction. There is a risk of an acceleration here. To say there isn't a risk of an acceleration is to say that this time is different, that yada, 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 right? So every time this starts bending upwards, sometimes it takes a little bit longer, like back here in the great financial crisis, it was moving up for, looks like about a whole year, and then it really went vertical. This has been going up now for a couple years, but it's the same thing, okay? It's the same pattern. We're slowly turning, and then it's going to rocket higher. Of course, there's a threat to the unemployment rate. But she has a good point there, the second half of that question, when she said that, look, here, I'll bring this up. I'm jumping windows, guys, a lot. Sorry about that. So she's asking that this dropped by a lot, even though unemployment, where's unemployment? Which one's unemployment? 4, this one. This one didn't change. Oh, wait. This one, 4.5. Yeah. The 4.5 unemployment didn't change at all, but this went down. So what gives on that? It's a good second half question.
If you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month.
So you're seeing a different risk to the labor market. That's what he just said, okay? A risk to the labor market. But this didn't change. So their models, whatever models they're using to get that flatness, right? The flatness to unemployment that we were talking about, whatever model that they're using isn't even pricing in things that they talk about at the meeting. Risks have increased, but it did not affect their model. Their model does not take into account risks. I mean, this is crazy. Dude, every time it feels like you're taking crazy pills when you listen to these people.
At the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor is really cooling off, and that tells you that it's time to take that into account in our in our policy.
So just looking at the SEP once again, the median participant inflation higher than previously expected by the end of next next year and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate.
Yeah, I like those questions. She had some good questions. She's looking at the story that's being told by these numbers, and she's like, it's not quite matching up here, Chairman. What gives? What gives? And he's not going to be able to answer it. He is going to answer it, obviously, but it's going to be a crap answer because there is no answer for it. All they do is follow the market. All they do is follow the market. Whatever gets priced in by the market is what they're going to do.
That we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed.
The labor market has softened, but you did not change your projections.
And so I would just say that the risks there have been less than one might think.
Whoa, I'm surprised that he answered it that badly. Jeez.
And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how
Whoa.
do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand,
Man, he's
which is
stumbling
now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
Like a follow-up, every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that?
Oh my God, dude. This guy is throwing out some monster questions. Oh, man. 2 years later. Oh, yeah. It's always 2 years later you're going to hit your target. And again, it's 2 years this time. Oh, my gosh. See what I mean, guys? They're starting to lose credibility. The writing is on the wall for the Federal Reserve. Okay. They're going to lose independence one way or another in the next several years. These questions, man, did he crush this question or these two questions? So first one was, if the risks to unemployment are from immigration, that's not in your purview. He should have asked the same thing, like, tariffs are taxes and political questions are not in your purview. Oh my gosh, that was a great one. Then he followed up with this. It's always 2 years away. You always hit your goal in 2 years. What kind of models are you running over there, pal? What kind of models are you running at the FOMC? Come on. 2 years. It's always 2 years out. That's why it would be the easy. Like, I remember talking about this maybe 2 or 3 years ago. And it was that one guy. I think his name is Matthew Mazinski or something like that. Mazinski. And he goes on to Marty Bent's show every now and then, and they talk about base money. Okay. And I was reacting to his appearance, and he said that he is not envious of the Fed right now, like being a member of the FOMC. because they're backed into a corner, or that, their job is so hard, they have to balance all these things. And I was just like, my reaction at the time was, dude, it's the easiest freaking job in the world. All you do is you watch what the market is pricing in. You do what the market is pricing in. And when you do your SEPs, you just draw kind of a nice curve to 2%. That's all you got to do to be a Fed chair, or to be a Fed governor, a Fed voting member. You just got to follow the market and have a nice curve to 2%. That's it. But these two questions back to back, boom, man, what great questions. I'm rewinding this because I just want to hear it again.
Your explanation of the Fed cutting rates because of unemployment, if you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation?
How do these guys keep a straight face? That's a killer question, guys.
Which has remained almost a full percentage point above your target.
Well, I was saying,
And this year, this SEP says you're going to hit your target 2 years later.
Okay, we got a little reaction on that one from, is this Leesman or something? And this guy just smiled. But man, killer questions.
2% not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems
There you go.
for you in telling people that that's what you're going to do if you can never reach it?
Credibility problems. That is exactly what it does. It brings up credibility problems for these guys. Holy cow.
well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create
A nice curve to 2%.
over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
What did he just say? It's goal seeked? He said it's goal seeked. He said write down the path that will get us to 2%. He just said that. That ain't good, man. That ain't good for him. Let's rewind this a touch.
And maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Wow. The exercise is to draw a curve back to 2%. Oh, boy, this is not good. Okay, guys, this is just an exercise that we do to show a path back to 2%. I thought you were supposed to be your projections. Where is it going to be in 2 years? Do you see a slowdown coming in the next 12 months, and then a policy response to that, and then that overheats the economy, and then you have to pull back? Like, there's no projection at all. It is just oh my dude, what we've been saying about forward guidance and about psychological operations, that the Fed is just a psychological operation. It is not a mechanical operation. It doesn't do anything. Just look at the yields. The 3-month priced everything in perfectly. This rate cut perfectly. It prices in every single rate cut perfectly. They don't do anything mechanical. It's just a freaking psychological operation on the general public. And he just admitted it, that it's goal seeked, and their exercise is to draw a path back to 2%. Oh my. No wonder. No wonder it's groupthink and clustered. They gave an assignment to kids with crayons. Draw a nice curve back to 2%. So let's go. Where are we at? This 31. Let's go back here and look at the dot plot. If you guys weren't watching back here, I was throwing a fit about the dot plot because I noticed the date was messed up. The date, they have the wrong dates at the bottom. They have 2024 instead of 2025 through 28. They have 24 through 27 on the slide here. But no wonder why it looks like this, because they gave some kids some crayons and told them, here is the current rate, connect the dot to 2% or 3% in this case right here. This is for rates, not for the actual growth or anything like that. So not GDP, sorry, inflation. This is not for inflation. This is for monetary policy. But they said, here is the starting point. Here's the ending point. Draw a colorful line. And they just connected those dots. That's what they do. And that's what he just admitted to. And it does not look good at all. This is a big, big problem, in my opinion. I mean, I'm telling you guys, rewind in 4 years from now, rewind to right now, and you'll be like, obviously they're going to lose independence. They have no credibility. Zero. Look, he does not look comfortable at all right there. Okay, I don't want to lose this spot. Leesman, I think, is going to. Okay, we'll just go here.
Urge people, as always, to look at the SEP as.
Oh, we got a couple comments. Yikes, yeah. Powell is using old data on purpose. maybe. I did see a comment from Telegram here. So this is Foxer and talking again about the Bitcoin price. During the last rate cut cycle that last year that we talked about, September, November, December, they cut rates, or September, October. Can't remember I think it was early November and then middle December, but they cut 3 times last year, and that coincided with a big jump in price. But then let's see, who was it? Tony? Was it Tony or Phil that brought up that it was coincided with November 5th? If you look at the election day, that's when it really shot up. And my response earlier was that was just some uncertain. It was already moving up, but then the uncertainty was relieved and the price really ran. It's not necessarily a product of the outcome of the election. I think the market knows the outcome of the election in the first place anyway. So, but Foxer has add on here. Can I zoom this in? Because it's hard to read from this far away. My contacts are not, they're kind of blurry right now. Anyway, I'll just lean in here. Okay, Foxer says it went from 69 to 100 in 2 weeks, then 69 to 80 almost overnight. And 69 to 80 in almost overnight. It was because the Trump election, clearly. Not clearly. I mean, it was moving up beforehand. And like I was saying, the market already knows what's going to happen with the election. I mean, if I knew it, the market knew it. I don't know what else to say. The election, the actual election, the result of the election did not affect the market. It was the event itself that relieved the uncertainty and allowed the price to go up. Few economic commentators want to make too much of that because it really sticks a fork in their favorite explanations of price movement, which is what gives them something to talk about every day. If the interest rate and money flows and all that only matter a fraction as much as investor sentiment, they don't have any unique insights and are out of a job. Okay. I mean, that's why we make predictions. We make forecasts. Yeah. Okay. Tony says didn't rates go up as well? Mortgage rates didn't help Dems for the election and treasuries. Maybe I'm wrong, but investment was coming in and bullish, but I could be off. Rates, you mean like mortgage rates? We can take a look at that real quick. Share this tab. We got mortgage rates here. We have to go to weekly. So bottomed last September, right along with the 10-year. I mean, it's really highly correlated with the 10-year. Yeah, bottomed in September and went up. But, guys, September is the end of Q3 as well, right? So we can see over here, the end of Q3 is pretty important when it comes to yields like this. So the mortgage rates, they topped here in October 2022. 2023, they peaked in October, which is right around that end of Q3, right? And then they bottomed at around the end of Q3. And maybe they're bottoming now. I don't know. But it's a really big inflection point for yields. And you say this didn't help the Dems for the election. I don't think that really had anything to do with it. I really don't. I think, yeah, it's a point that they could look and say, look, the housing market is broken. Look how badly the Dems handled this. Yeah, they could push that button. But I really think it was the reaction to cultural Marxism that won this election. It's the populism, the reaction to the Marxism, which is the populism. And that carried the election, plain and simple. And the market knew it. The polls were showing it the whole time. There's very little doubt. The only big doubt was, would they find enough ballots to swing it? Right? That was a possible doubt. But if with a fair count, there was no doubt who was going to win the election. And so the market already priced that in my opinion. Okay. Let's go back to Powell and continue going. Sorry, Puddington has, what is this? He says it still has been more or less a straight line up since 15,000 though. Did any of it matter? Oh man, good point, dude. We did look at that line. So if we go back to Bitcoin and we just zoom out, we have to get on the log scale. Just a very impressive linear move, stair step fashion, but linear move up. So did it all really matter? Not in the end. Not in the end. Okay, let's go back. Play.
Through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
It is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all.
Remember at the beginning, I talked about this teeter-totter. So unemployment and inflation are supposed to be opposites. And if you fight unemployment, you cause inflation in their mind. And if you are fighting inflation, you cause unemployment. So it's this teeter-totter of risks. And what he's saying is that usually they don't find this teeter-totter position very much. Usually they're behind and they're either cutting because we're going into recession, obviously, or we're raising because we're overheating. And so there's a clear path of least risk there's a clear path to lessen risk at any one time. But right now we're kind of in this teeter-totter moment where they're not sure. And I kind of feel that too. I mean, I've been saying that we had a chance to slip into recession. Are we actually in recession? I mean, they had all these jobs revisions. 1.7 million jobs disappeared in the last 2 years off of the metric. And are we in recession? I think we could say that we are in recession to a point right now. And I've been expecting a deeper recession, a deeper pullback in the future, though. So I've been always forecasting we're in a pre-recession period. And that's kind of what he's talking about here. We're in this pre-recession period. We're in kind of a funny area where asset prices are going to continue to go up. But there's this overhang, this deflationary pressure overhang. So we are in this pre-recession period. And I bet he expected a recession to come before now. And I did too. But I've always been forecasting this pre-recession period.
Surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that, but it's also partly about what's the right thing to do in light of this, of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So
no, you don't. Did you see the error bars on those things or the range bars? Everything is real tight. It's a group think. It's an exercise in group think, how to draw a line from here to our goal.
But we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right there that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Jurian says that I make these pressers a great watch, that you laughed out loud. That's great, man. Glad you're enjoying it. Like and share.
Hi, Victoria Guida with Politico. You talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do, and we don't frame these questions at all. See them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through help or hurt this political party, this politician framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and people they're making their arguments, and we're having a great discussion around these challenging issues.
He said absolutely nothing there. All right.
Base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy.
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the
negative revision.
I'm just gonna listen to that question again. Get it right on. Try. Uh-oh. I think I went too far.
111,000. The revision.
Golly. Where are we at? There we go.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes.
So more money. It takes more money and more people to do this. No. We saw this same problem in political polling. Gallup polling used to be door to door, right? Then it went to phone. Now everything's pretty much online. And it's really hard to get responses in the same old way. I understand if you send a mailer out, like let's say the BLS sends some mailer out to these businesses to collect the data, and they're getting lower response rates. Yeah, because you're using freaking snail mail. Okay. What you need to do is you need to say all these businesses should be registered on this, and you send them an email every month, and then they will check their email. They'll see this, they'll do a quick little survey, and you'll have really high response rates. I bet they don't do that because nothing freaking changes in the government. The answer is more people to send out more snail mail. It's not gonna help. The birth death model, that's important to understand. So in the unemployment rate, it's not births and deaths of people, it's births and deaths of companies. And that is completely it's like model driven, totally model driven. I don't think they actually count anything about how many businesses started and how many businesses closed. All they do is they impute it from other parts of the surveys that they get. It's radically bad data. Okay. Now, most of the time, I think government statistics are at least directionally correct, and they're after revision, they're probably pretty accurate. In the ballpark, I would say. Like CPI, I would say, is in the ballpark. GDP is in the ballpark. There are problems with them, but it's in the ballpark. But this unemployment rate, I think that they need to do a massive rethink on it, because the labor force participation rate it's just gone a straight line down. Like 20 years ago, it was, I don't know, 80%. Now it's 65%. And that doesn't show up in any unemployment data. So there's something massively wrong with the employment data that they get. And obviously all these revisions are showing that there's a massive problem with this. Danielle DiMartino Booth has come out and said one thing they could do is just collate the state data, because the state data is pretty good on this birth death model and on the actual employment numbers. They have really good data. Why doesn't the federal government just collate all the state data and put it out as a federal number or a national number? That would do a lot. And I think I'd have to go back and look for that tweet of hers, but I think she tweeted out the unemployment rate was way higher than what the BLS is saying. So no, they don't have good data to do their business. Well, they don't have good data if they actually did anything at the Federal Reserve, if they actually mechanically did anything at the Federal Reserve, they would not have the data to do their job. But since all they do is psychologically manipulate you, they have perfect data for that. they have just enough data that they need for that. So, yeah, I don't. This was a good answer though, or a good
It's not
question.
a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much.
Notice he did a physical collecting. So they probably do send out snail mail, guys. He actually did the hand gesture for how they collect them. Oh my God, the federal government, guys. This is such a joke.
Much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
You know, we have to live life looking through the windshield rather than the rearview mirror, as you know.
Oh my gosh, that was a great question. 53% off. And Powell just got done saying that the data was good enough for them to do their jobs, but it was off by 50%. And they got pressed on it. They pressed on it. Credibility down the drain, guys. Down the drain. Independence of the Fed is going away.
And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Gets called on it. Real quick answer. Get to the next person. Let's go. We're doing our job. Let's go.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well,
oh, man. He actually went, well. Let's listen to that question again. Another banger. Man, there's some good bangers this time. Wow. They're really letting them have it, guys. You could tell that they're shook. I think this whole Lisa Cook situation really has them shook and has the press. I mean, the press is corrupt, but the financial press at least is less corrupt, I think. Maybe to the point of being very low corruption in the financial press. Of course, the talking heads on the news state, on the shows on CNN and Fox, wherever, they're all corrupt. But these guys, I think, are less corrupt, and they are letting him have it. They smell blood in the water. Let's listen to this again. And then look how Powell starts his
Thanks.
answer.
Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minority unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation that shows you that
Talk
at the
about the
margin,
H-1Bs.
the labor market is weakening. I would also point to
going on with
labor force
H-1Bs?
participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
That's pretty dovish, man. He's fumbling here a little bit, losing control of what he is saying because they're pressing him.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market is
1.5% growth. So you guys know I've talked about that we're kind of in a depression right now. Not a recession, we're kind of in a depression. And Emil Kalinowski used to be on with Jeff Schneider. He coined this term, the silent depression. So not the Great Depression, but the silent depression. 1% growth might as well be recession. Not if you just get, like, if you pass 1%. So like if you're at negative and you pass 1% and you're going to 2, 3, 4%, that's not what I'm talking about. I'm talking about if you hold at 1% for multiple years, for a decade, between 0 and 2%, and then you punctuated the ends of that decade with a big recession where you had negative growth. That whole period is a depression. That whole period. And that's what we're in. Low growth, low inflation for as far as the eye can see. Now, if you are a kid today, starting out, 20 years old, say, you don't go to college, you get a job in the trades or start your own business or do something like that. And the economy is growing at 1%. There's not a lot of room for you, right? There's not a lot of room. As you're in low growth environment, you start getting more of a fixed pie scenario. Instead of there's room for everybody, there's growth for everybody. The economy is going to grow. But when the economy is 1% growth, basically zero, effectively zero, then a new person comes in to start a job or start a business, and there's not a lot of space for them, right? So then, of course, unemployment is going to go up. And it's going to feel like, for the youth, unemployment is going to go up. And it feels really bad for those people. It's not the same as 8% growth in the 80s. You know, boomers that made their money in the 80s, they have no idea what it feels like to be starting out today. There is no growth. Jeff Schneider calls this forgot how to grow. Okay. I don't say forgot how to grow. I don't think that's conceptually right because it's not possible to grow. When at the end of a credit bubble, we've been in a 75-year credit bubble, it wants to pop. It wants to pop, but they won't let it pop. They kick the can. They do all this financial engineering from the Federal Reserve. They do different facilities. They do QE. They do the reverse repo. They do all these other types of facilities that they're coming up with to save people, to save the economy, change the rules for you, not for me. So they do all this because they can kick the can. The government can borrow effectively unlimited amounts of money and spend it to prop up the malinvestment, the misallocation. And what happens when you lock in that misallocation and that malinvestment? Growth slows down because you have these underperforming or non-performing companies out there, these zombie companies. What percentage of the S&P 500 are zombie companies? So you have this lock in the zombie economy. That's what we're in. It's a silent depression. We should call it the zombie depression or something. I don't know. But that's what we're in. 1% growth ain't going to cut it. And they have no choice. The Fed can't do anything. The government can't do anything. The more government spending they do, the more misallocation and malinvestment happens, and the worse future growth gets. When they borrow money to spend it, they're pulling that spending from the future into the present, from savings into the present. What do they have to do then? Eventually you hit that hole in the future. Like when Biden and we had the spending for COVID, and it was like trillions and trillions of dollars on these stimulus. And then the next year, you probably remember this, Janet Yellen and Joe Biden go out there bragging about how they cut the deficit by $1 trillion. I mean, I guess that's good. I'm not passing judgment on whether the deficits are good or bad. But what it tells you is they cut the deficit and there is a gaping hole right in the future. And you're going to fall into that hole. What did they do just a couple months later? About 6 months later, they started picking up that deficit again because they had to pull more from the farther future to fill in that hole so there wouldn't be a big crash. So they can't do anything. They can't fix this problem. This is a problem of the structure of the global economy, a debt-based global economy. So when Jeff Schneider says forgot how to grow, that implies that you can remember. We can't remember. This shit is going down. It has to be completely reworked. We have to find new assets to base the economy on. That's why I'm so confident in Bitcoin. It just happened to come around when it is needed, when we need a new system. But how does that look? Okay. I don't think that when I say this shit is going down, I don't think we're going to have a crash. There is a possibility of World War III. Okay. If that happens, I have no idea how the global economy is going to react. It's going to be very, very bad. I know that. But if we avoid World War III, which I think is likely, and we just continue on in the future, there isn't going to be a crash because they can always change the damn rules. They can always bail people out. They can always nationalize things. They can always borrow more from the future because there's effectively unlimited amount of borrowing power from the federal government. They can always bail it out. So the two options, there's only one option. Okay, that option is zombie depression. That's it. That's the only option they have. Everything else is window dressing. We're going into dang silent depression for the foreseeable future. And along the way, they're going to adopt Bitcoin. It's going to slowly work its way. It's now, it's gotten into, I think it's past the early adopter phase. We are starting to get into the early majority. This is the large capital allocators. It's going to be on everybody's balance sheet. Every single stock on the S&P 500 is going to have Bitcoin on their balance sheet at some point. Every person is going to have some that's invested in the market is going to have some allocation to Bitcoin. It's going to be in there. And then they're going to have collateralized treasuries. They're going to have collateralized loans with Bitcoin. And it's going to slowly start taking over the world. It's going to be like a transition, like those, like you see a person's face and then it morphs into another person's face. There's no clear delineation of when it changed. It just morphed and eventually it's somebody else's face. It's the same thing with this financial system, the way it's going to change. It's going to be a zombie damn economy slowly morphing into Bitcoin and a Bitcoin economy. And I didn't even mention demographics. I mean, demographics is it's the glue that makes this economy not being able to take off ever. And even a Bitcoin world, hopefully by the time Bitcoin's adopted, the fertility rate's back up somehow, some way. But that's a whole cultural mess as well, because we have to change the gender roles in society to get the fertility rate back up. It's got to happen. So a Bitcoin world is not a thriving economy either, at least right off the bat. That's one reason why Bitcoin will be adopted, because we're not thriving. All right. I'll end on that rant. Let's see if there's any more comments. We got 13 viewers on YouTube. What's going on, guys? Make sure you like and subscribe. You can put question comments here. I'll stay on for another couple minutes. Let's check some of the prices while I'm waiting to see if there's any more comments. Okay, so Bitcoin. I mean, look at that. Up and down and now flat. Back at 115. Oh my God. Guys, I'm going to get old and gray and we're going to be at 115, aren't we? I mean, I should just put on the weekly candles. Share this. I wasn't sharing the tab. Let's just put on weekly candles. Oh my gosh. Look at that flatness. So depressing. Man. Okay. We will. I mean, we're still we're still on this upward trend, and I believe we're going to continue on this trend. I think we're going to continue with the stair steps. So if we zoom out and back here to the weekly, we have this, the way that the price has been moving, especially since the ETF launched right here. Stair step. I think we're going to continue. This is a smaller stair step, not very good construction here on this one, but the next stair step can take us up like that. Something is going to happen and it's going to do that. Maybe it's the rate cuts now that we're watching right now. And we're going to be like this, stair step up. All right. Until we break this yellow line, I'm very confident in this. MSTR, let's see. This is the weekly. Let's go to the daily. Looks like a bottoming, but don't know. Could go lower. Gold coming down on FOMC. Let's take a look at the where's the dollar? Yeah, right there. Okay, big bounce in the dollar, guys. Remember, I said this was going to be a bottom. It was going to bottom on or slightly after the rate cut. And this is due to the example from last year. It did the exact same thing. It was coming down harder. Then it flattened out from Jackson Hole. And then the dollar strengthened. Here we have Jackson Hole. It was coming down less hard, right? It came down hard here, but then it was pretty flat since about, when was this? April. It's been relatively flat, slightly downward bias. Jackson Hole, fake out. Now it's going to go up. Let's see. Let's see if that happens. Oil, not good. SP 500, nothing to report there. And US 10-year, if we turn on the Fed funds, so it's above the bottom of the range right now. We'll see how this develops in the next 6 weeks until the next meeting, but I expect them to cut 3 more times this year, maybe even more than 25%, 25 basis points, because I think we are going to hit some pretty rough patches here. I don't think the wheels are going to totally fall off, but it's possible. Usually doesn't happen, say, towards the end of the year. If it doesn't happen at the end of Q3, it doesn't happen. Sometimes it happens in mid-October. Like if you look at, like 1929, 1987, I think those were all October. Let me see. Okay, so we have 1929, Black Tuesday was October, end of October. Black Monday, October 19th, that was 87. .com, doesn't have a date. Okay, so those are the two big ones that they have here. Let's go into Wikipedia and go to kind of more modern. What does it say here? Those are the two big ones, the two biggest stock market crashes, I guess. October. Here's a mini crash in 89. October. September in the UK. March.com bubble. So March is also the end of Q1, is also another crunch point. That's when we saw Silicon Valley Bank, Signature Bank. Those guys, it really came to a head at the end of Q1, which is another crunch point. But the biggest crunch point is the end of Q3. September 11th, of course. Stock market downturn in October 2002. October 2007. September 2008. Okay, so I think that kind of proves it a little bit. Go back to this one. So if we're looking at the end of the year, I don't expect the wheels to really fall off the economy going through. If it doesn't happen in October, it's not going to happen this year. Bitcoin will rally through the end of the year in a nice, relatively calm zombie depression. And then we have to start looking at how the economy is looking for Q1 and the end of Q1. Now, like back in the great financial crisis, the economy really slowed down in 07 and 08, but then the real big stock market crashes didn't come until, well, we just saw the date there of 2008, 2009. I think that was what the dates were. Right? No, this is October 2007 and September of 2008. But the Lehman and Bear Stearns, those happened in 2009. And they happened Q1 and Q3. Same crunch points. So those are the crunch points that we really want to look at seasonally. If we get through October, then the end of the year should be smooth sailing into maybe February of next year. But that's how I look at these markets and how to have an overall forecast in this. But don't expect it to be clear sailing at really high growth rates or anything. For Bitcoin, yeah, but not for the economy in general. The economy in general is still on its path towards deflationary recession. Okay. This is a pre-recession period, I call it. All right, let's see if there's any additional comments. Check Telegram. Okay, you say that CIFR, Irene, Bitcoin miner bull market. Let's check those out. I have Bitcoin stocks all listed on this list. So we have Marathon is negative 1% today, but they have been doing really well. Let's take this off. They did have a couple big days here recently in September, but they are down 1% on the day. Let's see. Riot up 0.5%, same. They've had a really good August, September period. Clean Spark, same thing. They're having a good bunch of days here. Hut 8, look at that. Wow. Dude, I sold my Hut 8 too early. I had a little bit of Hut 8 stock, and I sold it too early. Let's take a look here. Cypher. Yeah, wow. That's doing really, really well. I don't have Irene on here. Yeah, they're doing great. Bull market for those guys. Well, the same thing's kind of happening with gold miners, right? Is it the gold? What's the ticker for the gold miner ETF? It's not GLD. I can't remember it off the top of my head. But they've been doing really well too. All these other treasury companies, MSTR down. Bullish is up 5%, but they sold off from their IPO pretty heavily, and they're putting in a higher low here. So we'll see how that goes. Metaplanet, I have dipped my toe now into some Metaplanet stock. Not more than 1% of my portfolio, but just a little bit dipping into Metaplanet, and we'll see. It's down 5% on the day, 4.5%. They did just close their round, so I do expect this to put in a bottom here soon and come up. We do have a divergence on Metaplanet. Bullish divergence from oversold. So that's a very clear sign that this is trying to put in a bottom. Okay, so that's all the stocks that I'll look at. Going back to Bitcoin, 115.9 now, kind of coming back a little bit from this volatility during the FOMC. I wonder what's going on Twitter, but I've been streaming long enough already. So let me go over here. No more comments. All right, that's going to do it, guys. Do it for today, guys. Join me tomorrow morning on the BitcoinTreasuries.net X handle. We do spaces, and I'm going to be live with John Fakori, Pay It Forward Dad. His company is acquiring, like he already buys Bitcoin for his company with their profitable company, and he's acquiring another company, another profitable company, for the strict purposes of using that profit to buy more Bitcoin. And I think we're going to see to him about that tomorrow. But all right, guys, thanks for hanging out, and I'll see you guys on the next stream. Bye.